a beginner in 2026. Imagine waking up at 7 o'clock in the morning. You open your laptop. The charts are moving. Green candles are flying across the screen. You see someone on social media posting a screenshot showing they made $2,000 before breakfast. And suddenly you think, I want to do this too. You deposit some money. You open your first chart. And then you realize you have absolutely no idea what you're looking at. There are candlesticks everywhere. Support, resistance, liquidity, order blocks. Fair value gaps, moving averages, trend lines, ICT, SMC, Forex, futures, stocks, crypto. And within a few days, you're more confused than when you started. This is how many people begin day trading, not with a plan, but with excitement. And that excitement can become very expensive. So if you're watching this in 2026 and you're thinking about becoming a day trader, this video is for you. Because I'm not going to show you a magic strategy. I'm going to show you a realistic path for starting from zero. 1. First, understand what day trading actually is. Before you open a broker account, understand what you're getting into. Day trading means opening and closing trades within a relatively short period, often within the same trading session. You're trying to take advantage of relatively short-term price movements. That sounds simple, but here's the problem. Simple doesn't mean easy. The difficult part isn't clicking buy or sell. The difficult part is making decisions when you don't know what happens next. Every trade has uncertainty. You can have a beautiful setup and lose. You can have a terrible-looking setup and win. That's why day trading shouldn't begin with, how much money can I make? It should begin with, how can I learn to make good decisions under uncertainty? That is a completely different mindset. 2. Don't start with real money. This is probably the most important advice in this entire video. Don't rush to make money. When you're a beginner, your first goal should be education. Think about it. You wouldn't learn how to fly a plane by buying one and immediately taking it into the sky. You'd study, you'd practice, you'd make mistakes in a controlled environment. Trading should be approached with the same respect. Start by learning how markets work. Understand candlesticks, market structure, trends, support and resistance, volatility, liquidity, risk management order, types, stop losses, position sizing, trading psychology. You don't need to master everything at once. You just need to build the foundation. 3. Choose one market. One of the biggest mistakes beginners make is trying to trade everything. Forex today, crypto tomorrow, stocks next week, then futures, then options. And eventually, they know a little about everything and understand nothing deeply. Instead, choose one market to study. For example, Forex, or stocks, or futures, or another market that fits your circumstances and risk tolerance. The specific market is less important than learning how that market behaves. When you focus on one environment, patterns become easier to recognize. You start understanding when the market moves, when it becomes volatile, when liquidity increases, when spreads change, and when it's better to stay out. 4. Don't collect strategies. This is where many beginners get trapped. You watch one video. Someone explains smart money concept. You think, this is it. Then you watch another video. Someone explains ICT. This is even better. Then you discover trend lines, then supply and demand, then indicators, then another strategy. Before long, your chart looks like this. 10 indicators, 5 rectangles, 3 trend lines, a dozen levels, and absolutely no idea where to enter. The problem isn't that these tools are useless. The problem is strategy overload. You don't need 20 strategies. You need one clearly defined approach that you can understand and test. 5. Build a simple trading model. Your strategy doesn't need to sound complicated. A simple trading model might answer 5 questions. What market condition am I looking for? What is my setup? Where do I enter? Where am I wrong? Where do I take profit? That's it. For example, you might decide, I only trade with the higher time frame trend. I wait for price to reach a specific area. I need confirmation before entering. My stop goes beyond the level that invalidates the setup. I risk a predefined amount on every trade. Now you have something you can actually test. 6. Learn risk management before you learn to make money. Here's something beginners often get backwards. They ask, How much can I make? The better question is, how much can I afford to lose? Because your first job as a trader is survival. Imagine you have a $1,000 account. If you start risking huge amounts because you want to turn $1,000 into $10,000 quickly, you may discover something very important. The market can destroy an account much faster than it can build one. That's why position sizing matters. Before entering a trade, you should know, how much am I risking? Where is my stop loss? What happens if I lose? And most importantly, can I comfortably accept that loss? Risk management doesn't make a losing strategy profitable. But poor risk management can destroy even a good strategy. 7. Backtest before you trust your strategy. Now you've created your trading model. Don't immediately put real money behind it. Test it. Go through historical charts and identify the setups your rules describe. Record them, trade after trade. Then calculate your results. How often did the setup win? How often did it lose? What was the average reward compared with the risk? How many losing trades happened in a row? Which market conditions worked? Which conditions failed? This is where something powerful happens. You stop believing that your strategy works and start collecting evidence. That's a huge difference. 8. Expect losing trades. Let's say you backtest your strategy. You discover that it works reasonably well. You start trading. And then you lose. Then another loss. Then another. You start thinking, maybe this strategy doesn't work. But wait, what if losing streaks are already part of the strategy? What if your system can have 5 losses in a row and still be profitable over a large sample? This is why understanding your statistics matters. A strategy doesn't need to win every trade, and you don't need to predict the next candle. You need a repeatable process with controlled risk. 9. Move to simulated or very small size trading. Once you've backtested, you can begin practicing execution. This is where you discover something interesting. A strategy can look easy on a historical chart until you're watching price move in real time. Suddenly you feel fear. You hesitate. You enter late. You move your stop. You take profits too early. You revenge trade. This is why practice matters. You aren't just testing your strategy. You're testing yourself. 10. Keep a trading journal. Every trade should teach you something. Record. Why did I enter? Was my setup valid? Where was my stop? Where was my target? How much did I risk? Did I follow my rules? What was I feeling? What could I have done better? After enough trades, you'll start seeing patterns. Maybe you discover you make your worst decisions after 2 consecutive losses. Maybe you discover you trade too much during certain market conditions. Maybe you discover your biggest problem isn't your strategy. It's FOMO. That's valuable information, because you can't fix a problem you haven't identified. 11. Learn trading psychology. This is where your journey changes. At first, you think trading is about predicting price. Eventually, you realize that trading is also about managing yourself. You will experience fear, greed, FOMO, frustration, overconfidence, revenge. The goal isn't to become emotionless. That's impossible. The goal is to create rules that prevent your emotions from controlling your decisions. For example, you don't take a trade because you're bored. You don't increase risk because you just lost. You don't chase price because you missed an entry. You don't change your strategy after 3 losses. You don't move your stop simply because you don't want to accept the loss. Your plan makes the decision, not your emotions. 12. Accept that you will not trade every day. This is another major mindset shift. Beginners often think, I'm a day trader, so I need to trade every day. No, your job isn't to trade. Your job is to take quality opportunities when they appear. Some days you'll get several good setups. Some days you'll get one. Some days you'll get none. And if there is no setup, you do nothing. Doing nothing is still a decision. Sometimes the best trade is the trade you don't take. 13. Don't quit your job to become a trader. This deserves serious attention. Social media often makes trading look like a quick path to financial freedom. Laptop, coffee, charts, luxury car, profitable screenshots. But you rarely see the losing months, the failed accounts, the emotional stress, the years of learning. Don't build your financial life around an assumption that trading will immediately replace your income. Treat trading as a skill you're developing. Your goal should be to become competent first, profitable second. Consistent over time is the real test. 14. Don't chase the $1,000 day dream. Imagine you're a beginner with a small account. You see someone making $1,000 in one day. You think, why can't I do that? Because you're comparing your beginning to someone else's highlight reel. Your goal shouldn't be, how quickly can I make a lot of money? Your goal should be, how can I avoid blowing up while I learn? If you can survive long enough to develop skill, you give yourself a chance. If you blow up your account trying to get rich quickly, the learning process stops. 15. Your first 90 days. So let's make this practical. If you're starting from zero in 2026, here's a simple framework. Days 1 to 30. Learn, study one market. Learn the basics. Understand charts. Learn risk management. Choose one trading methodology. Don't worry about making money. Your goal is understanding. Days 31 to 60. Test. Build a simple trading model. Backtest it. Collect data. Document your results. Find out what works. Find out what doesn't. Don't change the strategy every time you see a losing trade. Days 61 to 90. Practice. Move into simulated trading or appropriately small-size trading. Focus on execution. Follow your rules. Journal every trade. Study your mistakes. Work on your psychology. And don't worry about impressing anyone. You're building a skill. 16. What success should look like. After 90 days, don't ask, am I rich? Ask, do I understand my market? Do I have a tested strategy? Do I know exactly how much I'm risking? Can I follow my rules? Can I accept a loss without revenge trading? Do I have data from enough trades to evaluate my process? Those are much better questions, because becoming a trader isn't a race. It's a process. The biggest mistake you can make. And finally, there's one mistake that can destroy everything we've talked about. Trying to rush the process. You don't need to become profitable next week. You don't need to master every ICT concept. You don't need 10 indicators. You don't need to trade every session. And you definitely don't need to risk your entire account trying to prove that you can do this. Start small. Learn one market. Choose one approach. Test it. Manage your risk. Journal your trades. Control your emotions. And give yourself enough time to actually develop the skill. Because the real goal of becoming a day trader in 2026 shouldn't be, how fast can I make money? It should be, how can I become good enough to deserve the opportunity to make money? That's the difference between gambling on the market and developing a trading skill. Outro. If you're starting day trading from zero, remember this. You don't need to know everything. You need to know what you're doing before you put your money at risk. Learn, practice, test, journal, manage risk, stay disciplined, and let your skill develop over time. The market isn't going anywhere. You don't need to catch every opportunity. You just need to be prepared when the right one comes. If you found this video helpful, subscribe for more videos on day trading, smart money concept, ICT, trading psychology, price action, risk management, and building a consistent trading process. And remember, protect your capital, protect your psychology, master your process.